Alright guys, welcome back to the second of the series. So now we're on monetary policy. Specifically, what is the Fed and what does it do? Alright, so the previous one was fiscal policy, right? How the president and Congress have control of the economy. But the fundamental problem is that the government cannot be relied on to necessarily make good decisions regarding the economy because of, one, political pressure, in that it's never popular for them to lower economic output in any way, shape, or form. And that leads to the problem of elections and all that, because the elected officials are the ones in Congress and the president. Nobody wants to do things that are going to hurt their chance to get reelected. The second problem, of course, was that government is a big, massive thing, and it can sometimes be slow, especially when there's infighting and a lack of agreement. So instead, we use the Federal Reserve, and the Federal Reserve is separated in what's called monetary policy, meaning how it influences specifically the supply of money, whereas fiscal policy is the taxation the government takes in and the various ways in which it spends it and how much. The Federal Reserve instead has to do with the actual supply of money floating around in the form of cash, which can either bring the nation out of recession or an inflationary period. So, the Federal Reserve, by definition, is the national system of banks that influence and control the economy and the money supply. It is usually simply just called the Fed. Now, all of the nationally chartered banks and most of the state chartered banks, meaning things like Wells Fargo, Chase, Bank of California, those guys are all required to join. And you'll see on the map here that they're broken down by districts, where, for instance, in the West, you notice that these are all conglomerated. You've got all these states up here. You go to the East, where the states are older, you have more smaller districts. That's just a condition of age of these states. Now, it's run in a pretty basic manner. There are 7 members, including a chairman who's the one in charge and is appointed by the president. So these governors, as well as 5 presidents of Federal Reserve banks, form the Federal Open Market Committee, and this committee establishes the national monetary policy. Now, this part's really important in terms of the governmental aspect. They are not elected officials. They are government-appointed bureaucrats, meaning that they are people whose qualifications are based on actual, at least in theory, and assuming that your president actually does his job correctly, they are qualified by their knowledge, their expertise, their experience, and their education. And they're appointed by the president, which means that because these guys don't have to worry about getting reelected, they can make unpopular decisions. I believe this picture is a fellow named Bernanke from the 2008 recession and all that crisis, who, Times Person of the Year, but some of the decisions he made were deeply unpopular, especially among fiscal conservatives in the government who believe that you should never spend money even when the government is literally collapsing. But hard decisions were made, and therefore the economy was saved. So, what do they actually do? Well, first they act as the federal government's bank, meaning that they maintain the checking account for the Treasury and they process the tax payments, so things like refunds and borrowing and all that. They also do government security auctions, so anytime government bonds are going up for sale, they're the ones in charge of keeping track of it. They also, and this is the one that most affects us, regular people, on a daily basis, they're the ones who issue currency. They pull old money out of the system and they print new money as needed. They keep track of how much money is in circulation. They also are the ones who do check clearing, meaning that they're the ones who verify whether or not checks are legitimate or accurate or viable. They supervise lending practices, meaning that they monitor whether or not banks and loan companies are responsibly taking care of their loan programs. And lastly, they act as the final bulwark of cash infusions in economic emergencies such as the 2008 recession. Alright, so how does it work? In a real simple concept, guys, the Fed either speeds up the economy or slowing it down by adjusting the supply of money in play. So, to get out of a recession, such as a decade or so ago, the Fed encourages people to spend money by increasing the supply. And to stop inflation, if, say, for instance, growth seems to be expanding at too fast a rate to be safely maintained, the Fed can actually discourage people from spending money by decreasing the money supply. So they do this with three methods: the reserve requirement, the discount rate, and the open market operations. Now, the reserve requirement is one that affects businesses more than it does individual people, which is, by definition, the percentage of all deposits that a bank must keep in their vaults. So, for instance, if a bank has, like say, I have an account with my bank, I put $100,000 in it. Well, if the reserve requirement is 10%, the bank must hold on to $10,000 in cash of what I have, and it's allowed to loan out the other $90,000 in credit loan value. And what this does is it allows them to maximize 90% of it in order to make profit. If, on the other hand, the reserve requirement is at, say, 20%, they have to hold $20,000, and they can only loan out $80,000. So from a banking business perspective, this has an effect because it limits how much money, or allows more money, to go in and out of business loans. Now, these aren't just business loans. These can also be home loans. Excuse me. But again, this is not going to affect the individual person all that much compared to the other methods. So, how does this affect the money supply? Well, if the reserve requirement goes up, the money supply goes down because banks have to hold on to more cash reserves. If the requirement goes down, the money supply goes up. Now, the other thing that we get is the discount rate, which is when Fed lends money to the banks, and by either lowering or raising the interest rate they charge the banks, they influence the interest rate that banks charge their customers. So this one is one that has a big impact on people trying to take out loans, because the discount rate affects how much the banks get charged, and because banks are for-profit institutions, they are not there for your convenience. They're there to make money for their stockholders. Banks are always going to charge more than the discount rate. So if it starts at 2%, banks are going to charge 3% when they loan you money because they want to make money. If the Fed raises it, then the banks charge a higher interest. This is something that happens, say, since 2013 to 2019, as the economy recovered for 7 years there. We actually saw the discount rate go up slowly. Basically, not enough. They didn't want to raise it so much that it would damage the economic growth, but they did want to raise it enough that it kept it in check to a reasonable rate so that inflation couldn't get out of control from growth. So higher interest rate means less people get loans because you're only going to get it if you can afford it. On the other hand, during times where they want to increase spending and economic activity, the Fed decides to lower the rate, the discount rate goes down, and banks charge even less. Lower interest means more people get loans. Okay, this is what happened during the recession. Is the discount rate bottomed out so that banks were charged essentially nothing to borrow money, which meant that they charged very low rates to people, and it allowed people to take money and start circulating it, which helped with the recovery. All right. Lastly, and this is one that affects individual and normal average Americans if they are investing. And this is the open market operations, which is government sales of or purchase backs of bonds. Meaning that selling bond is when you take money out of circulation, or buying bond means you're putting money back into circulation from the government perspective. From our perspective, you might purchase the bonds that are being sold, so your money goes out of circulation, but you are holding it with the expectation that you are going to get it back with interest later on. And the same thing, the government, the Fed, will buy bonds back in order to put more money back into circulation. The money they've been sitting on, plus the interest, will then go back into circulation when they buy the bonds back so the individual Americans can sell them. Okay, so we see selling of bonds decrease the money supply. The buying of bonds by the Fed increase the money supply. So this is them sitting on cash, and this is them releasing it back into the wild. So we see this during the recession. The goal was to increase the money supply. So during the recession, the U.S. government decreased the reserve requirement, so banks had to hold on to less cash. They decreased the discount rate, so loans were cheaper for banks and therefore cheaper for Americans. And lastly, people, including myself, who had government bonds during the 2008 crisis, we were able to sell them back at a bonus rate because the Fed was attempting to buy as many back as possible in order to increase the monetary circulation as much as possible. This is called the easy money policy because the money's easy to get. And then the opposite of the spectrum, During growth periods, you decrease spending and money supply. So they increase the reserve requirement. Banks have to hold on to more cash in case of emergencies. They increase the discount rate, meaning loans are more expensive, and they sell bonds. So Americans who have excess cash are able to buy government bonds in order to sell them back later at a profit. And this is called the tight money policy. So there you go, guys. This is the part 2. So that is it for this week's lectures on fiscal and monetary policies. I will see you next week. And please keep in mind, guys, I apologize for my son's noise. This is the last of the academic topics. After starting next week, we are moving into purely the personal finance aspects. So we are completely done with macroeconomics. We're only going to focus on the microeconomics of personal finance. All right, guys, have a nice day.